Hey everybody, and welcome back to Investing with Wesley. Everyone wished they knew exactly what stocks to buy into and when to buy into them and for how long to hold them. That's almost like having a crystal ball to produce infinite wealth. And in today's episode, I want to talk to you about market rotations and how they're one very key aspect to that over-encompassing crystal ball. Specifically, if you can understand and see when a market rotation is going to happen, that can help you understand what stocks or what companies you need to buy and give you an estimated time on how long you should hold those companies for. So with that being said, let's get into it. So for starters, what exactly is a market rotation? Well, a market rotation in a broad sense is any time profits or the upside of one market switches to downside and what was downside switches to upside. Think of this like a bear versus bull market and so on. Every once in a while, there is a market rotation and it signals what companies or in what way or what strategy you should invest in for this foreseeable future. Now, when it comes to market rotations, there are long-term rotations and then there are also short-term rotations. Now, in this video, I'm going to be covering the long-term rotations, and in a later video, I'll cover the short-term rotations. So what are the long-term market rotations? Well, the long-term market rotations has a history about 100 years old, and specifically, it talks about the difference between growth and value stocks and how many times in history value outpaces growth stocks and vice versa. Now, because of inflation and different market depressions or recessions that happened over the course of the years, not every graph you're going to find online will tell you the exact same thing. And for the sake of giving you guys as accurate information as possible, I'm just going to lay out the facts. The facts are that in the past 90 years, there's only been 6 times in history where growth stocks actually perform better than value stocks. Now, some people will tell you that it happens every 10 years for a 10-year period, meaning growth will outpace value for 10 years, and then the following 10 years, value will outpace growth. But the truth is, if you crunch all the numbers, only 6 times in history has growth ever beat value. And the most recent one of these was from 2008 all the way up to 2020, where growth stocks completely annihilated value stocks. But really, what does all that mean? What's the difference between growth and value? And who cares if growth beat value in the past? You want to know what's going to come out on top for the foreseeable future. Well, let me break it down to you. I've already mentioned it in a previous video of mine, the difference between growth and value, but just as a refresher, growth stocks are companies that use the expectation of future profits to, in a sense, substantiate their current stock price. Growth companies will often not pay a dividend because they keep all their profits internally to continuously grow their company and further produce profits. Investors in growth companies will often invest in them knowing that currently they're not profitable and really make no fundamental sense to invest in, but believe in that company and believes that in the future it will be profitable, so they're investing in it now for those long-term rewards. Value stocks, on the other hand, or value companies, are already well-established companies that do pay a dividend and already have an established customer base and already produce profit. They're companies that have already gone through that growth process and are now just stable, really good, valuable companies. Examples of growth stocks are things like Facebook, Amazon, and Netflix, whereas examples of value stocks are things like American Express, Verizon Wireless, and Coca-Cola. Now, ever since the dot-com boom of the late 90s, growth stocks have been on an upward trend. But due to the crash caused by the coronavirus, we're actually seeing that value companies are currently outpacing growth companies. Now, is this temporary or is this for the foreseeable future? Well, like I said, only 6 times in history has value ever lost to growth. And because all these growth companies and all these tech companies are just being flooded with investors, it doesn't really make fundamental sense to continuously invest in them. Yes, big growth companies like Amazon and Apple are already profitable, so you might assume they'd be more value than growth. Remember, growth companies hold on to all their profits to further grow their company. And even though there are some growth companies that are extremely large and do extremely well for themselves, most growth companies, on the other hand, rely on other people's money, meaning they take business loans and lines of credit to just operate because they don't have enough profits to, in a sense, keep themselves afloat. Considering that we just saw growth beat value From 2008 all the way up to last year, I think it's safe to say that value will become the leader once again and outpace growth for the foreseeable future. So with that being said, I want to give you 2 strategies that certain investors use to try and not time the market, but rebalance their portfolios to continuously produce profits. The first one is taking advantage of market rotations, just like I'm saying, switching from growth to value. But in this strategy, I would have you tweak it to stay in value long term and switch in and out of growth the few times growth outpace value. Now, that wouldn't look like you putting all of your money into value stocks and then at the right time selling everything and loading up on growth stocks and vice versa. It wouldn't look like you trading one for another. What that would look like is you leaving your money in value stocks that produce a profit and will pay you a cash flowing dividend. And then at the right moment, you will sell a portion of those profits to take advantage of the upside that some growth stocks will give you. Now, once again, I'm saying take a portion of your profits, don't sell the whole thing. Stay within value and keep collecting those dividends. And if your portfolio is large enough, maybe even use those dividends themselves and have them reinvested, not into those companies, but into those growth companies that would be currently on the rise. Now, another strategy that people use to invest in market rotations isn't just on a growth versus value basis, but it's also on the business cycle and the sectors of different businesses. Because some businesses do a lot better during recessions than they would during economic booms, the different sectors that you could possibly invest in will give you a more broad way to invest your money and take advantage of the business cycle. As an example, if we were recovering from a recession, the number one sector that always does well in market recoveries is financials. And after financials, people usually move their money over to tech. And again, typically at the peak of a market cycle, people often invest in things like energy. Whereas during the downside slope into bear market territory, and even down to the bottom, people invest in things that always produce a profit. Things like utilities, agriculture, and so on. Things that people are still going to pay for even during market recessions. So in one hand, you have one strategy where you leave your money mostly in value, and every once in a while, when growth starts to outpace value, you move it over to growth, capture those gains, and then use those gains to reinvest back into value. On the other hand, you have a second strategy that breaks it down into market sectors and then times those sectors with the different stages of the market. Both of these are extremely popular and extremely viable strategies to your investing. The first one is more of a passive and long-term play that you could use different ETFs and indexes to, in a sense, invest your money and move in and out of them. Whereas the second strategy is a little bit more active. You have to do your research on which sectors perform best at which stage of the market cycle. So it's a little bit more active and a little bit more of a short-term play. But like I said, both of them can produce massive profits if you practice them well enough and if you execute them well enough. I hope you got value from this video. If you did, please remember to like and subscribe because it really helps the YouTube algorithm get this channel out there. I have a dedicated Facebook and Instagram account. I don't post there too often, but I'm on there scrolling pretty much every day. So if you ever had a question, comment, or just wanted something addressed, feel free to reach out to me there because I understand sometimes the comment feed can get a little bit muddied. Either way though, the choice is yours, and I'll see you in the next episode.